Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
I trust everyone had a wonderful, great July 4th weekend celebrating our founding fathers and the great nation, the greatest nation this world has ever known. And by the way, this last week I was up in Boston. I actually got to see the house of our namesake, Paul Revere, and that was pretty cool. We actually took a tour of it, and that was very good. Anyway, so there was no show last week, so we have some mailbag piled up that we're going to get to. But first, big news, news alert. State Street Global Advisors is rebranding to State Street Investment Management to better reflect their breadth of solutions and services to offer to investors. Along with their new brand, they have refreshed their logo and their brand identity to align closer with their parent, State Street, to create a stronger, more unified presence in the marketplace. How about telling investors when to buy and sell and get the hell out of the way instead of giving them a products package, Mr. Pie Charts or us? So let me tell you the exact transaction there. So State Street Global, they want to sound like an investment advisor. See, the parent is an ETF. They make a bunch of ETFs and mutual funds, and they make those. You get the emerging markets, the large cap, the mid cap, the growth, the bonds, and they sell those ETFs for your little Pie Charts or us, right? Well, now they want to go, instead of having State Street where they're doing it and selling it to Fidelity and Schwab, they want to kind of go straight. They want to be cut out the middleman. They want to kind of do it themselves too. So they kind of do it right at State Street. But the whole point is, folks, all of the investment banks on Wall Street, AKA the broker dealers, or AKA the BDs. In our term, we call them BDs, broker dealers. They hate to be called broker dealers anymore because it sounds like a used car salesman, which is kind of what they are. So they want to be called investment banks or Morgan Stanley Investment Bank, mahogany wood. But anyway, but they represent the companies, the municipalities, the governments, the nonprofits. You're the cattle, the product, the diversifier. I know I beat this to death, but I'm setting it up. So now we got an email from a listener and a client who had a little disagreement with me, had a suggestion that, I've been kind of doing this pie chart to us and kind of being a little vague and general about it. And I've kind of not really dove deep like I used to. I used to give a little bit more meat into the show, but he's got a good point. So we do need to dive deeper in that. And I am going to go in a little deeper because he does have a good point. Now, I would like to point out, folks, this show actually is for the retail investors to kind of get them under the curtain and bring them in. And then we get a little more technical toward the end of the show. But our weekly, daily market insight videos, we do a daily market update every night the market's open. That's the red meat. You want to get real market data, about 10, 15 minutes, drinking from a fire hose, go sign up for that. So with that, without further ado, now there are no show notes this week. Like I said, we were out of town. I gave the guys a break July 4th because they've been doing such a huge job this year and last year, and quite frankly, consistently. And so we gave everybody a week off. So now, this is 626. This is from MW. This is a guy that I was just talking about. Danny, I was reminded in the podcast today of how you work to be a bit more hard-hitting and dramatic in this podcast. That's fine, but I can't help wonder if you're losing comprehension for some new listeners that don't know what's really behind the common phrase, price is truth. You use that as a shortcut, and that's fine speaking to insiders. Actually, I was trying to hit the retail investors that didn't really know much about it. I thought price is truth is pretty easy to, one-liner. Anyway, I really think listeners could benefit from the concise definition of price is truth. So I've written out 3 quick bullet points, 30 seconds. Next time you drop the PIT grenade. Oh, price is truth. Got it. Price is truth grenade. 1, the latest market price is the single most important factor to pay attention to. Everything else is speculation or interpretation. Let me read number 1 again because he nailed that one. He nailed all of them, actually, but this is really good. Latest market price is the single most important factor to pay attention to. Everything else is speculation and interpretation. Folks, you can't eat or feed your kids with speculation or interpretation. The only thing you can feed your kids with is the net liquidating value of your portfolio. Whatever that price is right now, willing buyer and willing seller, you can sell it, liquidate it, and get cash and go buy something. That's what it's worth, not what it's supposed to be worth in 2 years by the analyst upgrades. Okay. Number 2, price action, or how price moves over time, is prioritized over other models or forecasts when evaluating a stock. Correct again. Narratives, this is number 3. Narratives, forecast, and even fundamental valuations are secondary to actual price at which the trade occurs. Very good. The above is the bare minimum before you move on to other things. Absolutely. For a longer discussion, you can continue with this. Current market price reflects the collective judgment of all market participants, regardless of analysis, predictions, or narratives, no matter theories or opinions about what the stock should be worth. Only actual price matters. Investors disagree about the intrinsic value of the asset's fundamental price. It is the real truth. They try to argue that's the real truth. You know what I think? You can't eat intrinsic value. Let me repeat that. Zach, you ought to mark this because this is a key point, folks. You can't eat intrinsic value. You can only eat price, the current price, not the future price. That's why they call them futures. Anyway, how does price impact our portfolio management? Instead of reacting to the news or forecast, we let current price and movement dictate our buy and sell and hold. Now, responding to what the market is actually doing rather than what we think it should be doing, forecast. That means we avoid holding losing positions out of stubbornness or missing out of trends because of disbelief. A stock's going higher and you go, "Ooh, I missed it. I can't buy it. It's too high now." Wrong. Anyway, it allows us to develop rules and strategies on price behavior using stop losses, technical analysis, momentum indicators, rather than relying on buy ratings, fundamental analysis, or long-term predictions. Folks, stop losses, technical indicators, and momentum price indicators, all technical analysis feeds out of at a minimum either price or volume, okay? That's why price is most important. Okay, so this is my thoughts. I should probably revisit this in more detail, but it's a good point. I've gotten more in depth in the past. I was simply pounding home the lie charts from the pie charts or us broker dealers and trying to keep it very simple. Folks, if you got that pie chart or us, that diversified, got everything, you got the rotten fruit along with the good fruit. Don always says, do you go to the store and buy rotten fruit for a balanced diet? Don't have rotten sectors. Okay. But if you've got that pie chart or us portfolio, you can get about a 7-8% return, and you're going to have to go down about 35% every 5 years or so, maybe 7. Okay. Revere, we're going down a third as much and making more money, decently more money. Call me if you want to find out. Anyway, I need to do the first quarter. I do need to explain in more detail accordingly. First quarter to show my intro price of truth. Let's find out what price is telling us. All right. So that was that one, and that was very good. This is the next one, okay? Now, I got done watching your video on July 8th. Connor, I'm flying back from Paris to LAX. Look at SOUN. It's setting up for a breakout, like the volume. Looks like volume is picking up. However, earnings are coming up. Just wondered if it was on your radar. It may be too thin for Revere. Connor, thanks for reaching out. The chart is looking strong, and based on prior history, it has a tendency to make sharp, rapid moves. It is more speculative with a high ATR, average true range. So risk management is important. That means you have to reduce your position size. Setup's very promising, especially given the strong volume yesterday. Keeping a close eye on. we would recommend a smaller position size due to its volatility and speculative nature. All right, that's good. This last one was on YouTube. Folks, if you want to get our stuff on YouTube, we post stuff every day. Just go to YouTube and just type in Revere Asset, just Revere Asset, pop up and hit subscribe. You'll have this show actually before the market close on Friday. Zach will have it up on our by about noon or 1 on YouTube. All right, this is a Connor question on YouTube. Great video as always, Connor. Wondering if I can request a segment on the podcast. Do you guys have any advice on handling days where your game plan is to observe the market due to overextension or suboptimal conditions for your trading style, but items on your watch list shoot up? In other words, you're nervous, you're getting signals that it's dangerous, so you're sitting out or you're waiting for an entry, and all your stocks you're watching are shooting up. I try not to overtrade, trade less, but on the flip side, I often get ROMO, regret of missing out. Folks, do you have ROMO? Do you have ROMO? Regret of missing out? Does that cause you to be a lousy investor? This is your money, your retirement. If you need help, reach out to us, okay? Now, the two biggest risks you have to manage around, that's a great point. Connor's going to do that for his segment. If you've got questions or comments or a stock you want to talk about, reach out to us. We'll go over it. But here's the two things that we have to manage around at Revere. You got drawdown risk, meaning how much you're going to lose, the total value of your portfolio. Did you lose 10%, 20? Like in bear markets, you go down 35. We go down 10, 12, 13 maybe. We're not going down 35. That's drawdown risk. Now, the other one is whipsaw risk, where you're over trading. If you put your stops too tight at only 2%, 3%, you're constantly getting in and out and you're spinning your wheels, you're over trading. So you have very little drawdown risk because those risks are inversely proportional. Because you have less drawdown risk, but you stopped out too much. So then as you move your stops further away from the market, now you have less whipsaw risk, but you have more drawdown risk. So the secret sauce, the way that Don plays the notes between the music between the notes, the rules, is identifying that. Okay? That's very important. In any event, if you can control, so the secret sauce is managing how much drawdown you're going to accept versus how much trading you're going to do. And we've done very well with that. In any event, let's go to the markets. Don, and actually that sequence of returns is very important, because not only is it important for that pie chart to us where I tell you you're only going to make 7% or so and you're going to go down 35% every 6 or 7 years. That diversification really doesn't help you because of sequence of returns, the order that it comes in. Also, with new clients, they may experience, if you're not careful and you don't assimilate them properly, they will get they won't track the way that Grotection tracks our long-term average. That's why you got to get them in incrementally. At the broker dealers, as soon as you transfer in, they sell everything you got and buy everything they got, because it's about the products. They don't get paid until you're in their products. We don't have products at Revere. I don't care. You're going to pay me no matter what you're in, even if it's in the money market. But I'll be in the money market too. My portfolio will look just like yours, so will Don's. So if you really want a better way to invest where your money, that's the name of this podcast, looks just like our money, the principles of the firm, come join Revere. Now, Don's going to tell you how we do it. Don?
Got it, Dan. So assimilation is especially important to discuss right now, and that's because, let me bring in our trend gauge right here. All 4 of the arrows are green, meaning leaders are acting well, and then we track the indexes across 3 time frames. The short-term 21-day, medium 50-day, long-term 200-day, all the indexes are trending above those levels, so each of those get a green arrow. However, on 7-3, we put this yellow caution up. That was on July 3rd, and the reason was we got historically extended, here's 7-3, we got historically extended more extended than historically the upper end of the warning range is against the 21 and 50-day moving average. In this case, it was 3.3% against the 21, which was over 3 ATR, and 6.7% against the 50-day moving average. Normally, over 6% on the 50-day is a red flag, and anytime you're 3% or more versus the 21-day, that's a red flag. It means you're in danger of a pullback. We got that pullback immediately on 7-7, but it didn't progress any further to the downside. And in fact, within the next 3 days, we made new highs. Let me get the line pen yesterday. So what this means is it's why we don't, as Dan said, completely sell everything, flip it over, and completely make a model portfolio full allocation for everybody. And it's because we're at risk of a pullback, and you don't want to buy stocks that are ridiculously extended to the upside for people. The new relationship is a marathon. It's not a sprint. We'll start slowly. The last thing we want to do is get a sharp pullback in the market and a new client is down 5, 6, 7% from when they first came in. So we do it incrementally, like the first day normally. Even though we're a bit extended to the upside, we'll take a 10% position in the S&P 500. We'll take a look at the individual names that we own. If they're not too extended, say we have a 4% position size, we'll maybe take 1% across 3 or 4 different names. Revisit the next day. Where are we with the S&P? Is it prudent to add a little bit more? And it's about a 2 to 3 week process at a minimum. If we do new buys, they get a full allocation of new buys because our stops are always tight on reasonable, tight relative to the overall portfolio value. We're not going to lose more than 0.2% in Grotection is where we set our stops for our initial buys. So there may be some paper cuts at the beginning, but the last thing that we want is for a new client to suffer anything worse than a paper cut. We've got a mechanism in-house to track this day by day to make sure that we're staying prudent in how much risk we're adding to individual new accounts. So let's get back to where we are in the market, and back on 623 and 624 seems like a while ago now. But over that weekend, the U.S. bombed Iran on behalf of Israel to bust their nuclear capabilities deep underground with the bunker busting bombs. And we gapped down the next day, sold off, and then the following day, everybody was waiting for them to retaliate. They retaliated. Iran retaliated. It was like with a slingshot and a couple of marbles, and we deflected those completely down. And then the next day, they announced a ceasefire. The ceasefire caused a sharp bounce off the 21-day moving average, and then we gapped higher the next day, and we've been running ever since. So great. We're involved. The way we do our allocations in the market is that we monitor the indexes against the 8 to 21-day moving average, the 50-day and the 200-day, as I mentioned. No stops were triggered on the indexes, and then we just let our individual names that we have. Some stops get triggered, some didn't, and then we start adding incrementally as things set up, give us low risk entry points. And we've got a good level to trade against when something like that happens. That's an episodic pivot, in this case, to the downside of the lows of that day. And we shouldn't revisit those. If we do, then the market is telling us that what we thought happened and what the reaction could be is not what we planned by adding exposure to clients. But it's worked very well. We went on a very sharp 7-8 day run, and now we're in a bit of a 6-7 day consolidation here. Tapped a new all-time high yesterday, pulled back a little bit. This morning, pulled back on Trump initiating 35% tariffs on Canada, sent them a letter. We gapped down, but we put in the lows before 15 minutes. Within the first 15 minutes, bounced where we want to at our ultra short term, the purple line, the 8-day exponential moving average, and we've been bouncing off of that level since then. The 8-day moving average, we're like 13 days above that now. That's getting a little bit long. We're around over 50 days above the 21-day moving average. That's also getting a little bit long. Just saw a very nice presentation on IBD Live this morning, too, by a gentleman, Eric Krull, and he reviewed what typically happens in the weak months of July and August. And 26 out of the last 27 years, we broke the 50-day moving average before September 1st. I'd never seen this stat before. Love that data. It's something that we knew anecdotally about summer weakness, but it's certainly something that we'll be keeping an eye on, as right now we are still extended, and we do still have that yellow caution signal on. That caution signal will come off if we get 4% or less away from the 50-day moving average. That means we're not necessarily extended. We may consider some new buys at that point, but we will have seasonality as a secondary indicator. The bull bear ratio is not a concern. The NAAIM sentiment indicator that we update every night on our tail of the tape pulled back from 99 to 86. So that alleviated a little bit of a concern. You almost always see market tops or the market pullback shortly after investment managers. That's the NAAIM. They get near 100% invested because, frankly, they've really got nothing left to buy if they're fully allocated. I know it can go up to 200, but you never see those readings because some just don't use leverage. And we fall into that category. We just really don't leverage up our clients. We adjust our risk and our exposure by measuring the risk and exposure of the individual names that we have. So that's where we are on midday Friday. The rally's been strong. We're a bit extended still from the 21 and 50-day moving average. We had an attempt to pull back 3 times this week, and each time buyers came in to make it an all-time high. Really, we're in about a 7-day consolidation. And that's we update levels every night in the tail of the tape for what our keys are going into the next day. The keys meaning if something happens, it may change the way we're having an overall outlook on the market. And right now our keys are, and they have been for a while, is the moving average is riding above the 8-day. The index is riding above the 8-day. You can see that on the S&P 500. You can see it on the NASDAQ 100. You can see it on the Russell 2000 I'll bring up here. And that's another in something also positive for the markets that happened within the last week and a half is small caps got above their 200-day moving average and have shown some relative strength over the last week and a half. So that made a new high yesterday off of the lows. And we're watching the 8-day moving average against small caps as well. So that's really the next key that would indicate something that we're going to do different in our allocations is if we start breaking the 8-day moving average on the indexes, and then we'll see what happens down at our next key level, which is the 21-day moving average. We'll monitor against there. If we get a bounce off there and we go higher, we'll add some exposure back. If we break below that, then we'll have our eye on the 50-day moving average, and we'll reduce some exposure there as well. What's happening in the indexes will impact 75% of names. That's a William O'Neill rule. 75% of the stocks in the market will follow the trend of the overall indexes, and that's proved by the 4 green arrows that we've got on the trend gauge that we also update every night in our videos. So that's really what we're looking for now is the trailing 8 EMA on the indexes. Are we going to continue making new highs, or are we going to start breaking these shorter term levels, and then we'll keep an eye to the next level lower? And I'm sure you've got some questions on that, Dan.
Don, you had me at episodic pivot.
Oh, episodic pivot. All right.
Sorry, I couldn't help it. So here's a question. Here's a comment because I want to explain that for the listener. So Don was basically saying the market's a little bit expanded above the 8 exponential moving average. It can still go higher. So for new clients coming in,
21, not the 8, the 21.
Sorry. He would add a 10% position. So Don, if a client transferred in and we were just bouncing off the 50 or say the 200, would you add a different amount of exposure, meaning like 20 or 30%? In other words, it depends on, yes. Right.
Yeah, we could ratchet it up higher more quickly, but still always with the same stops. It just
Yeah,
because
right.
when a key level of the 50-day, if you're bouncing at that level and you break below it, we can quickly take that exposure off and that wouldn't just be for that new client, it would be for all clients because we use that 50-day, right? We use that 50-day moving average as a benchmark.
So folks, the whole point
And also
is go. I was going to say, well, go ahead, Don. Go ahead.
Well, clients come in all different shapes and sizes as far as what their allocations are. Some come in already 100% allocated, and we have to
clean them up.
We review it. Yeah, and then we have to split that into, is it a retirement account and there are no taxable issues if we start selling some things versus whether or not
Fine,
it's
with
a
legacy
taxable
gains.
account.
Yeah, legacy position.
We're not going to rack up a huge tax bill for our clients either. So we score every stock that they have that comes in, set alerts, review them daily. Things that are not in a good position, we'll sell them out and reallocate that cash into our current positions. But we don't just blow everything out that they own either. If something's acting well, there's no reason to sell it. We'll just let it continue to trend up with the market and go through like 5, 6, 7, as many as 10 waves of assimilating over the next 2 to 3 weeks their account into our model.
So I've got a question for you, the listener. Is your advisor looking for daily episodic pivots and doing market research? Or are they just selling all your stuff, buying all their stuff, putting you in a pie chart to us portfolio, and then taking you to play golf? We don't play golf when the market's open. We're watching your portfolio. All right, Don, what is it? So you got the team now, right? Who's up?
Yeah. We're going to start off with Todd. He's going to talk about buying pullbacks versus buying breakouts. And there's a lesson in here that's tied to think about the approach that you're going to take with your buys relative to where the indexes are. Because again, 75% of the stocks are going to follow the market's overall action. So let's talk about buying breakouts versus buying pullbacks in the context of where the overall market is. Take it away, Todd.
Yes, thanks, Don. And I want to clarify that by no means am I against buying breakouts, especially after follow-through days. That's an important time to be buying breakouts and strength. But right now, after we've gotten extended, we have to be more careful about where we buy things. And I want to go over 2 examples of stocks that I've recently purchased on pullback buys and 2 examples of stocks that I purchased on strength, and you can see maybe the difference in the current market environment. And the first stock I want to talk about is AVAV, AeroVironment. That's a drone manufacturer. And you can see that you had this big gap up on earnings where it was up 21% on a monster earnings gap. So right away, that is definitely a stock of interest, and it ran hard 4 days after that earnings gap, not really letting too many people in. One of the attractive things about this stock is it has triple-digit sales growth coming up over the next 4 quarters too, which is very attractive. And in addition, you've really got some really nice volume in this pattern, both on the left side of the gap as well as into the gap. But the big thing that caused this particular pullback was a huge secondary offering. And they basically announced a $1.5 billion secondary offering, which set the stock into a 6-day pullback. And one thing that, we know over history is that eventually these big secondary offerings of the best companies will eventually get bought up and result in a potential buy point. And I ended up using the pullback to the 21-day moving average as the buy point in this stock because it gave me a very close out. If the stock was not able to hold the 21-day moving average, I would have stopped out of it. And also that was very close also to the earnings gap up low. So we had a very good low risk reward in this situation. And then last night we got lucky with a situation where Hegseth announced he's going to fast track drone production in the U.S. So you've got some nice follow through day and a nice pullback buy here. The second stock that I'd like to talk about is Coinbase. Now, a couple things in this chart on May 12th, it had a gap up on an S&P 500 edition, and kicked it back above its 200-day moving average. Then it consolidated for several weeks and had another gap up, and that was on the 18th, and that was the passage of the Genius Act by the Senate, which helped legitimize cryptocurrency at the institutional level potentially. So the stock rallied hard, and one thing I've observed throughout a lot of these very strong moves, when they're coming back up through the 200-day, the leaders will hold their 8-day moving average. And sometimes if you want to get into a strong situation, and keep in mind during this time, Bitcoin has also been setting up very nicely, which is a catalyst for Coinbase as well. I used a pullback to the 8-day moving average to get into this stock. And that was on July 1st. And again, if the stock failed and broke below that 8-day moving average, I had a very low risk of a few percent if that trade didn't work. So that took hold, and now I'm just managing the trade. And now to the two stocks that were strength buys. One is Toast. I bought Toast last week on the breakout through the flat base, and again, sized it small because I understand that Toast has this personality to it, but I didn't think it was going to be possible for Toast to fail for the third time through, the strength. Sure enough, it reversed out, stopped out for a relatively small loss, but here's an example of why buying strength in this particular market is very difficult. And this stock doesn't necessarily look bad, but it has this personality of just failing these breakouts. But so far it's holding the 20-day moving average, and it could still work. But I don't like to stick around when there's reversals off of failed breakouts. And finally, the other one is Rubrik. Now again, in the context of this particular chart, again, this is another one that had a secondary offering. I've watched it pull back to the 50-day and bounce off the 50-day a couple times. And it hasn't had a tremendous amount of power off the 50-day, but it's been holding it. And this week on Wednesday, I decided to buy the strength as it bounced off the 50-day moving average and traded through the highs of the previous 2 days. And then yesterday it had a bearish engulfing candle. So again, I bought it, was up on it a little bit that day, then it gapped up the next day and completely reversed out, and now it's broken the averages. So yesterday took basically a break-even trade of a couple percent loss on it and moved on. So again, I would encourage everyone to be careful buying strength in the current conditions with the extension.
Good stuff, Todd. The point being that even when you're wrong small, because of the way we risk manage and size our entries here at Revere.
Yeah, and look,
Appreciate
Don,
that.
Yeah, Don, real quick. So look, if he gets in and then he gets stopped out, it turns over and he loses a couple percent. But on the winning side, if he catches a couple that are runners and they run, he can make 10, 12, 15, 20, 30, 40. He can make a lot of money. So your downside is 5, 6, 7% maybe on the stop side, and then your upside is unlimited. So if you keep the losses small, that's the point. You always have to have if you don't know where your sell spot is, your sell rule is, before you buy it, you're a rookie. If your investment advisor does not know where he's going to sell that stock before he buys it, he or she is a rookie. You need to find, well, in our opinion, you need to find a better way. All right, Don, sorry.
Yeah, and Todd brought up a good point about the strongest stocks will ride the 8-day higher. You just saw an example of that. This is anytime we buy something, this is what we're looking for. We want something to just ride the 8 EMA higher, and it makes it an easy hold. We'll just count the gains. We'll keep raising our stops. A change in character then would be a break of the 8-day moving average. We take some off there. Then we look down to the next moving average, and it's the 21. This was setting up, a decent base. You had a downtrend line break there right before it was bought. On the downside, there was a little bit of there was some distribution during this pullback, but it was in a leading group. And like I said, so you take the position. You would have had a 20+% gain if you bought it here. Buying it here, looking for a resurgence, we just didn't get it, but that's okay because we're out with a small loss.
That's law of large numbers. Law of large numbers.
All you need is a 50-50 batting average and a 2-to-1 percent of what you win versus percent of what you lose, and you can do very well in the market.
Now, when he says that's all you need, that's very hard work. That's hard to do, folks. It takes a lot of work and a lot of diligence and a lot of discipline.
I don't know. I think everybody on Twitter is like a 90% win rate. It seems like so. Maybe
that's why they keep calling us. That's why they're catching us on Twitter and reaching out to us.
All right. So Connor is going to talk about what Dan set up early in the program, which is how you handle things when you're in overbought conditions. Take it away, Connor.
Yeah, I'll just repeat his question. This was from a viewer on the YouTube video earlier this week, and the question was, do you guys have advice on handling days where your game plan is to observe the market due to overextension or suboptimal conditions for your trading style, but items on your watch list shoot up? And I have a couple points I want to talk about in terms of this question. And the first one is always go into the day open-minded with a bull and bear case. As we know, the market is super dynamic, the news flow, and so it's ever changing, and the volatility is higher in this day and age in the market. And sometimes you can be going in with a bull case, and then you have the reasons what would change your mind. That could be the S&P breaking the 8 EMA or the S&P breaking out. So always having if the market did this or if the market did this, how would you change your tune in accordance to the environment? And then again, another thing we do is the keys on the tail of the tape. Those are the things that we watch every day going day, and this allows us to be dynamic. And when things change, we can adapt. We never predict at Revere. And then in terms of if the market's overextended and you have a list of stocks that you are watching as actionable names into the day, you can always take it down to 1/4 size. Something Don actually kind of taught me at Revere is it's never all or nothing. So say if your normal position is 10%, but you're worried that the market's extended, rightfully so, extensions from the 50-day moving average, you can always take a 2.5% size versus your full size. And this allows you to get into the name that you like. And then also, if it starts to pull back, you have less size, less risk, even if you're using a tight stop loss. So, and then if it starts to work, once you have a position, it tends to be easier to add on to a name versus watching something go up and not having a position. I found personally that if you have a little bit, it's just easier to, add another percent there, 2% there versus if you didn't take that initial starter. Sometimes it can be a mental gymnastics to get into something after you just saw it the other day, 2-3% lower. And then the other question was, I try not to overtrade / trade less, but on the flip side, often get ROMO, regret at missing out. And I think one thing to do to limit overtrading is really narrow criteria in what you're looking for. So you're only focusing on the best liquid stocks with strong fundamentals in leading industry groups. That's automatically going to narrow the list of stocks that you could trade. So, making that criteria more strict will limit the amount of stocks that you're watching. Therefore, you're not going to be looking at every different stock. You can only track so much. And then regret at missing out. everyone battles these feelings when they're trading. FOMO, it happens. It's human nature, but I think it's important to zoom out. One trade, in the grand scheme of things, isn't the end of the world. We're doing this for decades on end, and it's about the next 1,000 trades, not the one trade that you missed. So that, I hope that helps. That's just kind of some thoughts I had on your question and how I approach it.
You know, another good thing, another good exercise for people trying to learn how to trade, because people will do data mining where they have a belief. They think the markets, they're either bullish or bearish. They think they think it's going to go up, and so they start looking. You should always pick, like Connor said, you want to be nimble enough in your mind to be able to believe the market go up 10% or down 10% in the next couple of days. Either way, if you don't understand that, you don't understand the markets. Okay. But every morning before the open on your watch list, you should pick out your 3 favorite setups to the long side, and then 3 favorite setups to the short side, which ones you think are breaking down. Because then when you're wrong on days where the market actually goes against you, you'll start realizing there's more than one way to make money in the market. There's different, you can do it either way. But it also makes you realize more often that you're wrong a lot more often than you think. It highlights the fact that your opinions are really a lot of the media. It's a lot of noise. We're trying to separate the noise and take the emotion out of it. So turn CNBC off and just look at a chart. Anyway, thanks, Connor. That was good. Don?
Yep.
And now the moment you've all been waiting for. Ted is going to take over, and the Bitcoin breakout happened. He's been talking about it for a while, how it was one of his favorite setups. A lot of naysayers were saying it can never work. It's too obvious. Ted replied, well, that NVIDIA breakout that we just saw, maybe it wasn't Ted that said that, but the NVIDIA breakout we just saw was pretty obvious, and that worked too. Take it away, Ted. I know it's a great day for crypto enthusiasts.
Yeah, definitely. So, yeah, my segment is going to be in great detail here. I just want to outline our whole thesis, and there's so many components to it. It wasn't just technical analysis, at least for me personally, to find the conviction to take a full-size position. And I just want to back out real quick, start off with a weekly chart. We really just have a textbook cup with handle. If you've read William O'Neill's How to Make Money in Stocks, this could just be right in one of those top 100 model book charts he would put into the book. And so really starting in a larger picture, me personally, I've studied at the biggest moves and smoothest moves, and we want both, because it doesn't matter if a stock or crypto or an asset makes a big move. If you get shaken out, you're out and you're not going to catch the move. So I want to see the 10-week moving average trending higher, along with the 20-30 trending higher as well, and the 40-week moving average. So that was the first step I wanted to see. Of course, the price and volume. You had to undercut reclaim at the bottom of the the tariff war crash lows. And then you had this big move up the right side, fill at the highs and build this handle. And even the handle, you can go on the daily chart, you had a undercut and reclaim as well. So you had a double bottom in the handle that makes the handle even more constructive because it shakes out the weak hands and accumulated by the strong hands. And when we look at the daily now, after that shakeout, we got extremely, extremely tight and really perfect chart, linear action on the pullbacks and uptrends. And it was just really textbook technical analysis and price and volume action. On top of that, once you got tight, I drew an all-time high anchor VWAP, as well as the World War III scare, the 12-day war that ended quite quickly, anchored VWAP, and that all converged around this 106.6K area. That also coincided with 21 EMA and the 50-day moving average. So that's just a really concrete level of support as we were building this final consolidation before the breakout. And I've talked about volatility contraction as well. You had this first part, which we corrected 32% of the move. The second correction for volatility contraction pattern is right here, 13% of the move. And I've said before that oftentimes each subsequent contraction is about 1/2 the previous one. So we had about 30, and you had, let's say, 13-ish, so a little bit less than 50%. And then in this little pivot, there's only about like a 3.6%. So extremely, extremely tight. And after we broke through this double bottom pivot, which is like the W, the top of the middle point of the W, that's when it really triggered the breakout. And so far, we followed through nicely.
So, Ted, I've got a question.
Yes,
Now
Dan.
that you've got a full position, and now that you're at all-time highs, because now you don't have really technical like support levels to look at, or how are you going to manage the trade and take pieces off?
Definitely. So actually, I want to back up a little bit. Our first buy for Turbo was down here in 85,000. So we have a really good cost basis pretty much on the entire position. We had our first quarter position here. We're actually 1/5 position. Added up here, then added on June 9th. That ended up becoming a loss for a couple weeks, but it came back nicely.
That last buy, the third buy, okay.
Yeah, the third buy did not move. Well, it did first move immediately into profits on day one, but that faded so far on the World War III scare. But it wasn't that big of a like pullback, about 10%. And since we had profits on the first two buys, we were willing to give it more room just because of our conviction in Bitcoin. And then in this area, we put on our final piece, which brought us a full size position. And because we were already at full, we weren't able to add more on the breakout, which is totally fine because it's already a 13% position right now.
Okay.
And so back to your question, Dan. So we typically don't like price targets, and we never want to anchor our minds on a price target because if price never gets there, we're going to just have that anchoring bias. But there is ways in classical charting to set potential expectations and potential profit taking zones. One is just the William O'Neill breakout 20 to 25% plus. And if we did measure that from about 112, the 20 is about, let me scale that real quick. 20 is about this 135,000 area. So that is a potential first area, this 130, 135,000 area that I would look to take some profits or trim into strength. Another is in classical charting, there's two ways you can do a measured move, which is the top of the base to the low. I'm going to do this slowly so people can hear it. So previous highs to the low of the base, and you look at the dollar amount, which is about 35,000, and you take that and you add it to the top of the base. So 112, let me zoom that out a little bit even more. 35,000 puts us around 150K. So remember that 150,000 number because I will come back to it. The second way to do it is look at the previous move from the other base breakout, and that's also coincidentally about 35,000. So you can take that and just put it to the top of the base, and it takes you to the 150,000 area. So right now with those three methods, we have this 130 to 145, 50,000 area. That's the potential for our first trim. After that, we typically just like to trail moving averages. You can already see the 8 EMA is well above our cost. Even the 21 EMA is above our cost. And actually, even the 50-day moving average is almost above all of our costs as well. And same with those anchor VWAPs. So we have a lot of defense down here. You have the key 112 level and the 111,000 level, and we do not want to see either of those break. To me, that would be a failed breakout, and we would just stop out for a profit. I'm not going to say guaranteed profit because you can have a doomsday scenario where it just crashes off some news, but pretty much our mental stop now is in this 111, 112,000. We're not going to let that position come in on us, or else it just invalidates our thesis. So Dan, just quickly summarizing your point, our plan is to trim some in that 130, 135,000 area, and then trail the moving averages for the rest of the position, whether it's the 8, 21, and 50, depending on which moving average crosses our cost basis. So the price of volume and technicals was the first part to get me really interested in Bitcoin, and it's really textbook. The second was more the macro tailwinds. As we know, central banks around the world, governments are starting to enter more loosened monetary policy out of the tightening cycle that we have been through because of the inflation, global inflation. And so this is a chart of GMI is global money supply. So global money supply is this black line, and we see that Bitcoin almost tracks global money supply just with the 12-week lag. This is global money supply with 12-week lead. And so this was back June 22nd, so a couple of weeks ago. And that was during the World War III shakeout. And this kind of added on to my conviction along with price action, just because the correlation has really stuck, and we are pattern recognizers, and this is clearly a pattern of global money supply, which is liquidity. And when you print more money, that money has to find a place, a home, and one of those is Bitcoin, and that is what added to my conviction as well. And we just know that more money is being printed in this recent big beautiful bill act as well. So that's the second part of the thesis, macro tailwinds. Third is more sentiment. Heading on to the futures, Bitcoin futures commitment of traders data. You can see that off the lows, off the tariff crash lows, large speculators, which is this green line, started increasing their shorts. And even as Bitcoin made a new all-time high, they increased their shorts even more. And they're just heavily short. And when you have a lot of short sellers, when you have a lot of short sellers, while price diverges and forms a perfect technical pattern, that just makes me even more bullish. As you can see, we broke out, and this updates, I think, tonight or this Sunday. I believe the futures caught data, so it will be interesting to see the changes in the large speculators' short position. Once that gets back to neutral, that could also be a potential trim area, and especially if that coincides with like a 130 to 140,000 Bitcoin level as well. On to the next, Google Trends data. I used how to buy Bitcoin. This is pretty similar to Bitcoin or BTC as well. But if you look at the 5-year chart of how to buy Bitcoin on Google Trends, you can see right now we're at about pretty much 5-year lows. And this is the exercise I want to take you guys through. Let's look at the previous spikes as well as the turns. So in this area, I'll say we started turning here from the low levels. Let's say November 8th through 14th of 2020. Let's go back on a weekly chart. November 8th to 14th of 2020. You can see it's about this area. November 2nd, November 9th. That's when sentiment on how to buy Bitcoin started changing, this October 4th to this November area. And that's precisely right here, coinciding with this huge base breakout that led to a 440% move. The second point, this was actually the only point on this analysis where it didn't coincide with the base breakout, but it was near a major low as well. September 11th through 17th, let's just say that is the area of 2022, which is about right here. Of course, we didn't make new lows, but in the grand scheme of things, that was near major lows. But continue on to August 13th of 2023, that was pretty much right in this area before this massive late 2023, 2024 move, which we made 170%. Then we based around for 10 months. So as you can see, as this trend curls out of lows, that's when you see the move. And when you get the spikes, that's typically when Bitcoin sees more retail interest. And we know that institutions accumulate far before retail. So when retail interest flies, that's usually when you want to start become a little contrarian in your thinking. So as you can see, this August 2026, 2023 area, that's already when Bitcoin has broken out. And finally, this last data point, October 20th through 26th of last year, it was pretty much right here in this area before the election. We curled up and we made a 56% move after this Google Trends data started curling up. And as you can see, we've been at 5-year low depression levels, and we are starting to get this little spike. If we go to the past 30 days, you can see we're starting to see that breakout from these lows here. So that just added on to my conviction as well. Fourth, people on Twitter and their feeds are often subjective. The algorithm feeds them what they want to see. So, the bottom line is our feeds are subjective and not objective. With Grok 4, and especially the new Grok 4 model, it has all access to X data. So for me to get an objective feel of X sentiment, I asked it, how is the sentiment on X on Bitcoin compared to previous major lows and major tops? Create a benchmark measurement for me and put into a table. So it did that, scan all of X, analyze the major lows and major highs of Bitcoin right here, and then it put into a table for me. So you can see major lows came sub 15, extreme fear 10, 15 extreme fear, 6 extreme fear, and 1 was in the fear area. And then major tops came above 80. You can see this 95 extreme greed, which was at 2017 bubble. And then you had the extreme greed of the 2020 COVID bubble. And then you had this year's major high after late 2024's run, which hit 80. And then we had this recent May one. But in this July breakout a few days ago, I queried this a few days ago on the breakout day, and it was only at 65 greed. And Grok's sentiment analysis was, it's not extreme as past tops, indicating room for upside before potential correction. X posts reflect cautious optimism, which is honestly what we want to see. We want to see some people cautious, doubting the breakout, because that actually allows the breakout to work. And with accumulation signals, new wallets. So this is one use case of Grok or AI that I've found recently as well. And then finally, crypto, fear and greed. We've just entered the greed territory, but for the last month, we're all in the neutral, and we actually dipped into fear on that World War III shakeout. So going back to this chart, perfect cup with handle, full moving average alignment, and really the daily. What's super crazy to me is that on this day, July 8th, we received the full moving average alignment, and this is with EMAs, but I like to use SMAs for trend actually as well, and I found it gives lesser false signals. And that was the day we did see the 20 SMA cross over the 50, and the next day we had the breakout. So full moving average alignment, the macro tailwinds, heavy shorts from large speculators, and sentiment was not overheated. And so far, the Bitcoin breakout is working tremendously.
All right.
So
All right.
the fat pitch came. We took the pitch, and it's in the middle of the air right now. Hopefully, lands outside the park or the stadium.
Well, even if it's not, you've at least got a double right now. So, and if we manage it right, we're going to get a triple and hopefully even a home run. But folks, here's my question. So Ted's a young gun. He's about 25, 26, right? Your advisor's probably 55,
24.
24. Excuse me, he's 24. Does your advisor sound like that? Is your advisor looking at 4 different entry levels when he's entering a position, a very bullish position? Is he taking the time and in incrementing into the position? See, you've always told you're supposed to average down in a position. Folks, brokers tell you, average down. If you liked it here, it's a lot cheaper now. The question is, why didn't you sell at a stop loss? Why were you averaging down 20% lower? That's not how you do it. You actually want to average in and feed the positions that are working, that are doing good, like Bitcoin. But that's how you manage it. So anyway, that's one way to manage it. Don, do you have anything else?
I do not. That was a very impressive breakdown on Bitcoin. And Grok 4 is fantastic. I used it for several things last night that would have taken me an hour to do, and I was done in less than 5 minutes. It's amazing.
Yep, it is amazing. All right, folks, listen. If you liked what you heard, please tell a friend, tell a neighbor, so they can also get stocks that have episodic pivots and not getting stuff that has anchoring biased, okay? We have rules at Revere. If you want to find out about those, just go to revereasset.com. Up in the right-hand corner, there's a subscribe button. This podcast will go in your inbox every Saturday morning, and every night the guys do a video. It's a 10-minute video. Every night the market's open. A short. That's like drinking from a fire hose. That's pure market stuff, like the second half of this show. And that goes out every day the market's open. We're the most transparent advisors, not only in the country, but in the world, in my opinion. I mean, I don't know anybody else that's putting out what they're actually doing every day in the portfolio. Not only that, your money will look just like our money. The employees have these same portfolios. Don and I, the principals, have these exact same portfolios. So your tracking will look exactly like our tracking, down to every position size, position percentage, timestamp, when you bought it, price, everything. Well, except I don't charge myself a management fee. You have to pay the management fee, so you'll be net, I'll be gross. Other than that, everything's the same. But in any event, just tell them to do that. And then if you want this show before the market closes on Friday, we record this Friday morning, you can go to YouTube and just type in Revere Asset and hit subscribe, and you'll have this in your inbox. There's 2 ways to get our content. YouTube, Revere Asset, and then our website. We actually have a few weekend specials that don't go out on the newsletter on YouTube. So there's actually probably a little bit extra stuff on YouTube too. So I would check out both, folks. And you can always call us old school at 855 Real Wealth. Folks, we will talk to you next week on your money. Not their money, your money.
Because it's not how much you make in the markets, it's about how much you can keep.